It's a very interesting time in energy, and it's a very, very complex system, but we have spent a lot of time on trying to understand the impacts of the energy transition. Now, in terms of what has caused what you refer to in terms of these shortages and high prices, we really see there's two factors. The first one is there's been a lot of underinvestment in fossil fuel energy around the world, and that really has been due to two factors. Firstly, prices have been low. That usually lowers investment. And secondly, there's been a lot of ESG pressure on firms not to invest. And that pressure comes from sometimes activists, governments, sometimes even courts. So overall, there's been underinvestment. But I think what we need to understand when we think about the energy transition is that fossil fuels at the moment account for something like 80% of primary energy. And as I spoke about last time, resources like gas and oil have sort of 5 to 7% natural decline rates. In other words, they run off fairly rapidly unless you invest. So given that we're not yet in a position where renewables can take over even just all the growth in energy demand around the world, we do have to keep on investing. And we heard that sort of referred to by Guy Debelle last week in a speech where he said that new fossil fuel investments are not inconsistent with the climate transition. So we do need to keep on investing, otherwise our energy supplies run off quite rapidly. And we've got to remember that this is in a world where by 2050 we will have another 2 billion people on this planet. And we may have doubled the middle class on this planet as well. So base demand is still going to be increasing. So the energy transition is a vast undertaking, and because of that, it will inevitably be fairly slow. Now, the second reason why prices have spiked is, of course, the enormous fiscal support that has been given, the enormous increase in money supply that's led to increased demand for everything, including energy. And you referred to some of the different regions around the world. They all have somewhat different dynamics. In Europe, it is a gas shortage pushing up coal prices. In China, it's a coal shortage pushing up gas prices. And the US is somewhat better positioned, partly because they are not as import dependent, and also partly because under President Trump they really didn't do anything on in terms of climate change. Look, you're absolutely right. We have been surprised because I think last year we knew that these low prices were unsustainable, but they've gone from too low to really quite extraordinarily high prices, and they will not be maintained, particularly prices for thermal coal, coking coal and gas. We are really just at extraordinary levels. It's really only a question of how long will they remain high. And of course, the lead indicator there is CapEx. And so far, as far as we can tell for 2022, CapEx remains in those sectors remains very low. So the higher prices may last longer than they usually would, but it's fair to say that those extremes, they can't last for particularly long. I don't think I want to be in the business of trying to forecast the oil price because nobody knows, and I know I don't know. The only thing I would say is that in Australia, we actually don't have that much direct exposure to oil itself. As you know, we have a lot more exposure in Australia to gas. And yes, a lot of the gas contracts are linked to oil, but they are separate markets and they have quite different dynamics in the long run. So the prices may eventually diverge between those two. I mean, just to give some examples, China's increasing its regas facilities, that's import terminals for LNG, by 100% from 2020 to 2025. They're clearly not going to increase their oil imports by 100% over that period. Electric vehicles, they're clearly a negative for oil demand. They're a positive for baseload generation because we need more electricity. So quite different dynamics. And when we look at the oil price today, which is at $85 or so, it's already the case that the spot gas market in Asia is trading at the equivalent of $210 per barrel oil. So the prices have diverged quite a bit, and they may continue to do that. I mean, normally you would expect them to do both, of course. I think the risk is that there is no supply response in the traditional fossil fuels. And in that case, of course, the only way you can balance demand and supply is for prices to go so high that you destroy demand. So I would think that if the oil price doubles again from here, $170 let's say, I think that will cause a global recession because it just destroys demand, when prices go that high. So unless we get that supply, that may be a risk. I mean, if that were to happen, that would be very positive for the energy transition because it would provide enormous incentives to switch from fossil fuels to alternatives, would increase investment in renewables. But it would also be an absolutely perfect environment for the existing fossil fuel producers in an environment of really high prices and very low capex. So they would produce enormous cash flows, which some might reinvest in renewables and some may not. Look, I mean, let me talk about both of them in a little bit. I mean, last year I called Whitehaven a special. It was under $1, I think, when we spoke. And as you say, it's tripled. What has also happened, though, is that the company's been transformed by these high prices. When we spoke about it, I didn't know that, but it was a company that was going to earn more in this half than its entire share price. So at current spot values, and there's an extraordinary thing, the company may make $3 a share. When we spoke about it, it was, as I say, below $1 price. So this sort of cash flow absolutely transforms, the value of a company like that. Now we take a very conservative view of our valuation. We assume that the boom lasts exactly 1 year. History suggests they tend to be a bit longer, and everything reverts to normal at the end of that. We apply high discount rates. We leave 80% of the resources in the ground. We attribute no value to things like Winchester South and take big discounts on the other assets. But clearly our valuation and everybody's evaluation for the stock has gone up because of these phenomenal, really transformational earnings. So what we've done, we've sold 3/4 of our shares, we've lowered our weight, but we still own some Whitehaven. The intriguing possibility is that we've been attending a lot of calls with Chinese coal producers and users and so forth. And there seems to be a view emerging in China that the price may remain above $100 for thermal. Now we use a much lower long run price. We use 72 at 77 cents exchange rate. If it really were $100, this Whitehaven makes, even on a normal year, earns about 50 cents. In which case you have a company that might make almost $3 up front and then 50 cents forever. That's worth a lot more than the current share price. But that would require a real change in the market that we're not really convinced of yet. And we haven't put that in. Woodside's quite different in the sense that it's a much more stable, much less risky company than Whitehaven. It too is at spot values on something like a 30% cash flow yield. So now, because most of their gas is sold with oil-linked contracts, but that price has gone up. But about 50% odd goes on spot prices, and as I mentioned earlier, spot prices in Asia are incredibly high. So we think in some ways that Woodside is almost a better proposition now in terms of risk reward than Whitehaven. There has been, of course, a big transaction in Woodside. As you know, they're buying the BHP Petroleum assets, which changes the company quite a bit in several ways. For the first time, they have some real oil exposure. Now, the oil exposure is fairly short-dated in the sense it's all upfront cash flow. They're buying it through a share issue, which is the major negative in this deal for the value of Woodside because they're using shares that themselves are quite cheap. It's very hard to do a good deal with scrip when your scrip is undervalued. But the assets they're buying at a very reasonable price. And post the transaction, I mean, Woodside will have a phenomenal balance sheet because they're doubling their assets and more than doubling their cash flow with the same debt. So they're now in a position to really, if you will, decide on their own fate in terms of the projects that can internally finance their growth, projects like Scarborough, and of course they're doing Senegal and the like. And interestingly enough, the deal, in terms of the metrics, closes on the 1st of July in terms of the cash flow these assets generate. So all the cash that's being earned by the high oil prices at the moment goes to Woodside. So I would say, it's a undervalued company with a phenomenal balance sheet. We don't really, use these sort of macro thematics to drive our views, but it's fair to say that it's having an enormous impact on producer prices. In China, they are up, over 10% currently. The German numbers came out on Wednesday, up 14%. Producer price inflation, which incidentally was the highest since, can you believe it, September 1974. which was the month after the enormous oil shock of 1974. So it is an enormous one-off push of inflation due to that. And of course, the risk with inflation is that high inflation itself can change inflationary expectations. And if people act on those expectations, it becomes a self-fulfilling prophecy. So in other words, even short-term high inflation can trigger inflation itself. But really, by far the largest reason why I think we need to be worried about inflation, and at least think about that, is that there are a lot of sort of structural changes that have occurred recently that suggest that perhaps we've come to the end of the low inflation era. And we spoke a little bit about energy and the enormous capex that's required there. The demographics have turned somewhat. We're seeing deglobalization, we're seeing tariffs, we're seeing a much greater emphasis on inequality, which means more social spending, more minimum wage increases. And lastly, of course, the enormous fiscal spend that we spoke about last year. You'll recall that I spoke about the fact that of every $4 US dollars circulating around the world, a bit over $1 has been created since February 2020. So there are a lot of people telling you why labour markets are so tight and what are the dynamics behind that. There are people talking about why goods markets are experiencing inflation, while why energy market prices are up, while commodity prices are up. Almost nobody puts it together and says there are 35% more money in terms of US dollars chasing around the world economy. So that presumably also has some effect. We have looked at the evidence, and there was some academic work done not that long ago, which incidentally sort of confirmed what you might expect, namely energy and resource stocks tend to do well in that sort of environment. Although there is a risk that if those prices go too high and produce too much inflation, we do get a global recession. I think it's fair to say that if we get significant rise in inflation, balance sheet financials might have a lot of problems. I mean, banks obviously due to credit losses when interest rates rise, but even also insurance companies with long-dated liabilities because they inflate. I think the other sector that would presumably do quite badly would be the more speculative high multiple stocks, and that would be really just because of the starting point rather than on any particular economics.